Welcome to the Mr. R Show, presented by the MRR Institute. This podcast is designed specifically for tax professionals looking to scale and modernize their practice by maximizing revenue through resources. Join us as we explore expert strategies, innovative tools, and actionable advice to help you navigate the evolving landscape of the tax industry. Whether you're aiming to grow your business or enhance your client experience, you're in the right place. Now, let's get to the show and transform your practice together.
Hey everybody, and welcome back to the Mr. R Show here, produced, edited, everything else you can think under the sun by the MRR Institute. So if you don't know what that is, we might tell you, or you can just read about it. Look in the show notes, check it out, check out the website. We'll put that in the show notes as well. I like to say in all of our other shows, you can't be lazy around us because it's right in front of you. So don't be lazy. Click on links, follow them, as well as we're going to put some stuff in there with the guest that we're going to introduce here to you shortly as we tackle this topic, which again, read it in the title, read it in the show notes. We brought this guest on in a little bit of a side note, and then I'll let my co-host give the true introduction, because I'm sure you guys are tired of listening to me and my co-host, Chris Bakiro, go back and forth. So we bring people on the show that are way more interesting than me and him. So isn't that right, Chris? Is that the whole purpose of this thing, right?
Other than getting your free CPE, I think the entertainment value is there. And no, I think this is a great way for us. I mean, honestly, it's a blessing to be able to attend conferences, to meet other tax professionals, to learn from them, to collaborate. And with our podcast here, I love having guests on because we're all, many of us as tax professionals and accounting professionals, we feel like we're on an island sometimes. And we live in either a certain community where we have a very community focused practice, maybe in a certain town or a segment of a city, or we're in a community as far as a niche, maybe a segment. And so whenever we find someone that's an expert in a segment, especially if it's interesting, I don't think we're going to have the best tax pro for underwater basket weaving people on, if there is
Although
one.
we might. I'm sure they exist. I'm sure there's a magazine for that. There's a magazine for
Homes and
everything.
Gardens. John, I think that magazine's probably defunct. I don't know.
Who knows?
I haven't been to the grocery store forever. I beeline that thing. But anyway, but I'm so excited. As you know, we've had the honor of presenting, and when I say we, an MRR Institute, and at the last 3 NATP, National Association of Tax Professionals, Tax Symposium conferences. This last one was in steamy Las Vegas, Nevada. Nice and warm. And I attended a session that walked through tax strategies, which of course, that's what I do. I do tax strategies and plannings, but for influencers. And we were able to get our show sponsors to increase our budget and bring in a special guest. So Marit, Burmood, thank you so much for joining us today. I know the people that listen are going to get a lot from you. Thanks for joining the MRR, or Mr. R Show, rather.
Thank you for having me. I have to say, you might have called Vegas steamy. I called it freezing. I was freezing the whole entire time. So I wore a dress with a cape. I had a lot of cardigans. Steamy for the man, but cold for the female. Very cold.
It was steamy outside. Yes, it was.
No, I didn't get outside much. Yeah, I wasn't outside very much.
I didn't go too much. We made it that Wednesday. My wife flew into town and then was able to stay Wednesday to Friday. We made it to the pool bar, the adult only pool bar. She fired up one margarita and it was literally $45. And now, I'm like, holy guacamole. So, I know us accountants could be thrifty, but that was just highway robbery.
So your credit card was steaming too.
Oh, the credit card was
drink.
steaming. It blew up. And I was thinking to myself, man, maybe we're around a bunch of influencers, because there was a lot of young people at the pool renting out cabanas at probably $2,000 a pop and going through drinks like water. But we digress. To excited having you on the show. Before we jump in to tax strategies and for influencers and some funny tales and tips, because a lot of people that listen have a tax practice. that is very general in nature. And they might have that one client that all of a sudden gets into becoming an influencer, and they don't know how to handle them. And that's where someone like you could be very helpful. But how did you get into this field? You're both a CPA and an enrolled agent, so a huge overachiever in a positive way. We hold both of those designations in very high regard here. But how did you find your way into this profession and then into this niche?
So I found my way into the profession of accounting. It's so funny because I have an entrepreneurial spirit. And so I went to college to learn accounting in my late 20s. I was 29. So I've gotten all these credentials over the past, oh, I'm going to tell you guys how old I am.
Few
Like,
years, right?
14-ish years. I'm in my 40s now, but I started in my late 20s because I really wanted to start a business. And I knew that if I didn't have at least a decent grip on accounting, then I could maybe not even get loans or funding or whatever. And so I went back to get my bachelor's in accounting, and then that was where I got into tax. I started working for a CPA, preparing, and quickly realized that, taxes and payroll and all of that is what will take the business down. Started helping other business owners. And one day I was having babies. I was getting my CPA. I was getting my enrolled agent. I looked around and I said, I have my business. I hadn't even been taking it seriously, but for years I'd been doing it on the side when the kids are in nap time, all tax season, all the weekends. And my business became helping other entrepreneurs. So I really have this combined love where I have so much, it's like an obsession for tax, if you can't tell. I also have my master's in taxation. And so I found myself teaching tax pros. I teach a lot of different groups. You and I met at Taxposium. I love to educate. So I have this soft spot for the tax pros because, you said we're on an island. We feel like we're on an island. That was me for so many years. And then I also have my passion for business owners. So I kind of try to teach everybody. I guess I'm just like a little teaching mama out there. So that was kind of how I got into my business. And then with the influencers, it was just kind of a thing that happened. I had one client that was young, making a few $1 million a year. He had been looking for accountants and couldn't find anyone that he could relate to, and we just had a really good rapport. And after I looked at his tax return from the prior year and I found one box that was checked wrong and I saved him $20,000, and that was it. He's like and he'll be a lifer because he's like 22 now, I think, or I think I got him when he was 20. So we have a long way to go, but he's been referring me all of his friends. And before I knew it, my client list was actually full, and they haven't all stayed on. I have some funny stories, like you said, where they aren't always a great fit. I've had highs, I've had lows, but that was the word has gotten around that I'm a CPA that they can talk to, that knows their industry and can help them, as long as they're just not wanting to commit tax fraud, which some of them are, but then those are the ones that don't stay. So
Right. No, they're in every industry. We niche
yeah,
in
they are.
real estate, and it's interesting because you mentioned something that's so important, and we've talked about this. We have a peer-to-peer mastermind group that we're involved with, and we talk about as a tax professional, we have to understand there's two different skill sets. There's the technical, I prepare tax returns, or I advise clients on taxes. I might even do tax planning and advisory, which we know is very high value activity. But I'm also a firm owner, and those are completely different skill sets. And same with me. I got into this business because I'm more of an entrepreneur. I started my entrepreneurial journey when I was in middle school as a paper boy, and I'm going to share my age because I was flinging papers back in the day, like that video game. But I had to take care of accounts receivable, accounts payable. I had to pay the Detroit News. I grew up right outside of Detroit. I had to pay the newspaper for the papers. Had to go. Like, think about this. I would go door to door and collect cash from people, randoms. It was but that taught me, like, I love entrepreneurship, and I just felt like accounting was going to give me that avenue to be an entrepreneur. So it's great to hear that. And you're doing something we talk about all the time, let your best client pick your next client. So you've got this person that's an advocate of yours, and we talk about, who's your fan, and it's keep bringing great leads to you. So, can you tell us a little bit about your practice, and are you, are you 100% in working with influencers, or is there, um,
No, I think I would go crazy if all my clients were influencers. And I have been um, talking with other influencer or other tax accountants and kind of, we're in the industry, we chat. And just like everybody wants to niche and pick their ideal client, I also try to do that. I go through my client list. I kind of see who I don't love, who I do love. But really, my practice is based a lot on personality, a lot. Because I have one client who's amazing and he does a lot of construction and he's in the one of the worst states to do taxes, which is Ohio. And
oh
I would
gosh,
never let him go in a minute because he's the
yeah,
best. I have another client who's a licensed clinical social worker. She's wonderful. I've got some real estate clients. And so they're all over the board. I just keep them to the people that I really work well with. And so it's the same with the influencers. They don't all stay, but I have a decent amount because it's really, really hard for them to find professionals that they, as they say, that they vibe with. And so, I the one of the big reasons why I really wanted to start teaching about this particular avenue is because there are so many practitioners that feel instantly stressed out if they come across an influencer because everything is so gray or they are completely shut down. So there's like these kind of two pockets. There's the tax professionals that will get an influencer client, and I'm talking about ones that make a lot of money, right? Like if you just get one and let's say they have 400,000 followers. I have clients with 1.7 million, right? And I remember one of my first clients, she had 350 on Instagram. And I was like, whoa, she must be just like huge, right? And so they either are completely intimidated, and then that's when you can get walked all over, as every taxpayer will walk all over you if you're not strong and firm in your convictions and your ethics as a professional. Or there's the old school hardcore accountants that are just like, nope, 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 nope. And then that turns them off completely. And so just I kind of wanted to get out there and just spread more information that can empower them to make better decisions if they decide they want to work with this clientele, which to each their own if they don't want to.
oh no, I understand that, and I love, it's just thinking about, personality, and we in our practice we developed, and with MRR Institute, what we call the ideal client formula. And there's three parts of it, but one of them is that you enjoy working with them. So as I was just thinking about the personality portion of that relationship, and that's really important. We are very fortunate to have these our practices, and we want to. We've got to design them the way we want them to be run, and that includes
Hmm.
our client acquisition process. So
Yeah.
influencers, they have some unique nuances. In understanding the correlation between maybe how many followers they have versus their revenue, what are the typical revenue streams you're seeing these influencers uh, bring in?
That's a really good question because I think that when I do my discovery calls with these clients, a lot of time their very first beef is that their old accountant doesn't understand them or their old accountant messed this up or they can't talk to them and they don't know what to write off and they don't know what they're allowed to have and they're very frustrated, which it's funny because you can have a 20-year-old influencer or a 46-year-old insurance salesman, and they both don't know what to write off. So that's no shade to the influencers, but I think accountants have a harder time kind of deciphering to tell that to guide them in the first place because they don't know how they're getting their money. So I have a client, for example, she just threw it in the other day that she's starting to get Snapchat crystals. And I know how the platforms pay. So this is called platform income. I heard Snapchat crystals, and she's an advisory client. You were talking earlier. I just have to make a plug for influencers who are making a good amount of money. Not all of them, but the ones who can afford advisory, they are great advisory clients because they are some of the most creative people out there and they are hustling. If they're making a lot of money, they are hustling for it. They're doing brand deals, they're getting the platform income, they're doing TikTok shop. So these are some of them. So they can enter into a brand deal with another company, which is kind of your most traditional form. It's almost like the old school marketing where the marketing agency would contact the talent agency and they'd come together and they'd come up with some sort of deal, for the talent to promote the product. But the influencers these days, they're not represented by a talent agency necessarily. A lot of them are lone wolves. And so when they're getting these opportunities, and maybe not a brand deal, maybe it's just a sponsorship opportunity, like you create a post this many times and we'll give you this product for it, or well, it's generally product for posting. They're like, okay, and they just sign. They're like, yay, I'm getting paid to do this. This is great. And they can be taken advantage of. Or you don't know anything about it. And as a tax professional, it's a little harder when they come to you and you have no idea how much free stuff they've gotten. It's very hard to figure out the fair market value of everything, which we can talk about further. But when you have the advisory clients, that's where you can really come in and help them shine, because now you can help them keep track of it. You can help them understand the implications of the things that they're doing, because they might not understand, but the company sure does understand. They're going to write it off as a marketing expense and they're going to say who they paid. And, if they're not handing out a W-9, then the influencer isn't getting a 1099 because or they're filling out the W-9 to their social. So it can be messy. I digress. This is why we first want to learn about how they make their money, because it can just get so crazy. They can get into a deal or a partnership. And my tax pros out there know what it means to enter into a partnership with someone else. They don't know. They're like, I have another friend who's really awesome and popular, and we created this little side project together, and we're doing it. And you're like, what? Alarm bells, they're ringing everywhere. Back up what's going on. And so they can do partnerships, sponsorship deals like per post, brand ambassadorships, things like the Snapchat crystals, where Snapchat, they get paid for how many views they have on their stories. And so they're just taking stories all day long. And then they're taking stories all day long. So is every single thing that they do a write off? Because they're doing it all for the stories for the Snapchat crystals. So it gets very confusing, which is why I'm so passionate about just kind of trying to give some guidance to the tax pros on how to deal with everything. It comes at you really fast.
Oh, absolutely. I've got some, and I've been thinking about some interesting situations on your end. So
Oh,
first of all, is before I get into income, this sounds like it's a bunch of crotchety, the positive, like I can't stand when you've got a bunch of crotchety people on a golf course and then you get that call like, my buddy said I got to write off this, it's like, luckily our client, we lead with tax planning and strategy, so we really don't run into that very often. But my buddy did this, or so and so said she wrote off her trip to Italy. Like,
mm-hmm.
okay, so I'm sure in the influencer world,
I
they're supposed to
last
take
night last night I got sent two posts from a tax influencer, a big one on Instagram. One was about the QBI deduction. What qualifies for this? And one was about paying off something, but they're a shareholder, like for themselves through their business, right? So yeah, it's no longer the golf course. Now it's social media posts that they send
Yes.
you saying, well, can I do, all these ridiculous posts. So same thing, different form of delivery.
Well, I'm kind of glad our clients don't listen to this particular podcast because I can't tell you how much it annoys me. But you know what feels great? When a client sends you something that they saw on TikTok and we say, that's interesting. Did you look at our YouTube channel and see that video in our podcast, our other Teaching Tax Flow podcast up? And guess what? We put that in the newsletter in May. Oh, yeah. And usually after that, they're like, okay, yeah, there's not, the FOMO is real from some of these people, but income. So they've got a lot of different revenue streams. What about how are those conversations about getting in-kind payments? Like tickets to sporting events and good services.
Yeah, so those can get complicated quickly, and I actually had something I wanted to throw back at you, which I'll bring up in just a minute. But yeah, those get hard. So especially my female influencer clients, they'll get the med spa treatments, right? Oh, come fill me yourself at the med spa, and we'll give you all of these treatments. And they don't realize, well, this is a benefit for benefit transaction. They're not paying you cash, but you just got a free med spa treatment in exchange for posting. The company is definitely expecting some sort of financial gain from this. And so now you have a taxable transaction. Those are super, super hard, especially they don't understand it. And so it starts to get hard. It's hard for the client. And so I actually was talking about this to another tax group on Monday, and another tax professional came on and said, well, I have a client who she gets so much free stuff. Free, it's not free. She gets so much product in exchange, and I've been helping her track it, and I've been helping her, report the fair market value, because that is what the IRS, if you go by the book, they want you to report the fair market value. It's just like the old school bartering transactions. Nothing this is I got to stop and say nothing is different with these influencers. Everything you know as a tax professional in terms of foundational knowledge still applies. So this bartering transactions of, oh, well, I traded this for this, and then the IRS says, well, that's income to you, so what's the fair market value? It's the same thing for them, right? So there's court cases on this. You've got Bogardus versus Commissioner, Commissioner versus Duberstein. They're kind of they're kind of discussing gifts versus compensation and what is the difference. And it always comes down to reporting that fair market value. But so he says at the end, when we go to file her taxes, she has no money. And so maybe she might sell this dress that she paid $300 for. That's the fair market value. When she sells the dress for $100, then can she take it as a business loss? And I was just kind of, my mind, I should have stopped and I should have written it down, because my mind went to inventory, because he said she has all of these products and then she's selling them. And I'm thinking, okay, well, it could be an inventory situation, but then you might have a sales tax issue, right?
Right.
And so you've got your cost of goods that you paid for, and then when you sell it, I guess you just paid more, and so it would create a lower net income. And then someone else jumped on and said, could you look at it as a capital asset and actually take a business loss for selling the items? And then someone else went on and says, was there personal use, because that would change it if it's a business asset
Right.
or not. So what do you think? I wanted to ask you, would you
Ooh.
put it more in the inventory category, or would you put it more? And then he said, well, can I depreciate the dress? And all of us said, wait, we wouldn't depreciate a dress.
Why would you? Oh,
That's
so fact pattern
so
is taxpayer gets a dress.
yeah, we're going to use the dress as an example.
All
She
right.
gets the dress. She takes it as compensation because she's got a
Sure.
good tax advisor that says, hey, this dress, the fair market value is $300.
Mm-hmm.
And then she needs money, so she sells it for $100.
And is this a one-off situation? Like
He was saying that's a good, yeah. See, that's why my mind went to inventory.
Yeah.
He said she does it with a lot of her things.
Okay, so if she's doing with a lot of her things, I would, so the $300 of compensation is income, because that's a fair market value of the
Yes.
dress. The $100 she received, so she's going to have a $200 deduction somewhere. You could, if it was a one-off thing, I would probably, gosh, this is a tough one.
It's a tough one.
It is a
Then
tough
you
one
would
because,
then it would reduce the basis, the $100, right? If you did it as a capital asset.
yeah,
And there might
exactly.
not be an answer. This is and we didn't come to a set conclusion. I don't think you can figure this out in an hour-long call.
If it was a situation where this happened within a short period of time, like she got the dress, she wore it, she posted, she sold it, or for $100, I would probably just record $200 of income.
Yeah.
That's my thought,
Okay.
because it was worth
There you have it,
300.
people.
It was worth 300, and she sold it for 100.
Yeah.
Here's the problem: she's got phantom income. The
Yes.
other argument would be, Well, once they give her a dress and she puts it on, it's used and takes the tags off, is it really only worth $100 at that point? Is it now a wholesale value? Did she get any, is her personal use from posting it $200 of compensation? It is a very fascinating
Mhm.
situation.
Yeah, and
Um,
this is one of, this was kind of what I wanted to illustrate with the in kind or the fair market value of items instead of this cold hard cash. If we as a community can kind of come up with a standardization about these concepts, I think it would help so many people because you and I could sit here and rap for another hour and write it all down and
right?
map it all out. And, you see this all the time.
Can I ask this question? In exchange,
Sure.
dress, was it, did she generate revenue from wearing the dress or posting about it?
I
Or was
don't
it
think
just a,
so because she did it for the company, so the company generated the revenue
okay. Oh, man. Well, so
until she
she
sold it and generated that $100.
so the argument would be her only real compensation is the value of the dress for the time she used it,
Mhm.
which is very limited. It's
Yeah.
really fascinating. I guess IRS would look at it and say, well, it's you pay tax on $200.
Yeah,
Um,
probably. I think so too. And I think if she was doing it a lot, we'd kind of treat it as almost like she keeps a sort of inventory of used items that she buys and she uses it in the business and then she kind of sells it in and out. But the capital asset argument was good and I was like, I
yeah,
could see that. Okay.
but you know what? I would say if we take the argument, which I think would be beneficial to her, you say when she received the dress, it's $300 of revenue, and it's inventory of $300, like kind of what you're saying. When she sells the dress, you credit inventory 300, or, you know, um,
Yes.
so you'd reduce the inventory.
And you're gonna
You'd have
debit the cost of goods sold, which
hmm
is $300.
and then should ultimately just have $100 worth of income
Yeah,
potentially, right? Because so
yeah.
that would be
So
more
it's a
beneficial to
200.
her. Yeah, instead of 200. I'm just thinking out loud. This is fascinating. Um,
I know I got him John, I got him stuck in the rabbit hole where
mhm.
this episode's gonna be twice as long.
No, I am loving this because it's very rare that I could find anything to put him on a spot with a valid question.
I
So
wasn't
you
trying to
gave
put
him a
him on
good
the
one.
spot, but it is something that
Oh, it's
there
great.
are so many options, right? There's so many ways you can go depending on the fact pattern that it's like I thought, "Oh, I'm going on this.
You know what?
Let's ask Chris what he thinks, you know? Let's
Yeah.
get another opinion."
I personally feel like it would be she should pay tax on $100. I know that's not might be very pro taxpayer because here's my thought. If she received the dress for $300 and she gets to keep it and use it indefinitely as personal use, then that's $300 of the value. She didn't.
Mhm.
She wore it. She wouldn't have bought the dress if she wasn't doing that shoot. She was part of her compensation was the dress that she turned around and sold for $100. So I would look at it as $100 of income. And that might be pro taxpayer, but I can make the argument. That's just because I'm thinking, um, yeah, it's not like because part of the $300 value is that you own the dress indefinitely and you can wear it over and over and over again.
Mhm. Yeah, and that personal benefit definitely plays a part in that, so the more she can treat it as if it's inventory that she is getting in exchange, but then she's putting it in a separate space, she's storing it, she's selling it, then that would also strengthen that argument for her. And this is the basis of everything we're talking about when it comes to, I guess maybe not services in kind, that one's just you're just out of luck on that, but if it's products, unboxing products, boxes of I have another client who is pretty famous. He goes to a lot of shows where a lot of people are. And let's say he got a box of sunglasses from his sponsor. He's sponsored by someone, huge box, cool sunglasses, really nice. And he was handing them out. And so that was another one where I'm like, well, yeah, he's got to take that compensation. That was a lot of money in sunglasses. And this is the thing. I've talked to other people in resolution about this. And the IRS will do these brand audits. I've talked to two people who have confirmed it, where they'll go to the big brand and they'll review their advertising and their marketing category. They'll say, who did you give all of these products to? Because you're writing them off. and then they can find the people, and then they can cross-check, and your client could actually get an audit just for being on the advertising list. And so,
Wow.
it's kind of something where the IRS is getting smarter, and they're starting to figure it out. So if your client's getting $1,500 in sunglasses, but then guess what he did? He turned around and he gave them all out at the shows to everybody because he doesn't need 500 pairs of sunglasses, right? I got a pair. It was a big win for me. They're really cool sunglasses. But so then it's like, is that now a marketing expense? Because he took the 1,500 compensation, but then for his brand and for his company, he was like, have one, have one, have one.
That is because
So,
I'm still thinking about him and then the dress girl, because I'm
mhm.
just the dress girl. What would I practically do? I'd probably record $300 of income and put $200 of returns and allowances, just because
Oh, I like
it,
that.
and
Returns and
no,
allowances.
because that's really what happened. She ended up flipping this dress, and I don't know. I don't know what I would do, because if you just that way you're recording the gross income, the value of the dress when she got it, but she salvaged it. She sold it. That's
Yeah,
okay.
and if we could figure that out as tax pros, because a lot of these influencers, they don't need all this stuff, right? Like they don't need a million dresses. So if we could figure that out and say, hey, let's turn this crappy situation, because the tax pros talking to me, he's like, it just sucks. It sucks for them. And I'm like, it does suck for them. So that's a value we can bring as an advisor, is to help them think of creative ways now to first expand their income. I said, get her doing other things, right? If she's all she's getting is in-kind payments, let's start urging her to do other streams of income like we just talked about. Let's get her some actual cash instead of the phantom income. But if we can also provide that additional value to say, hey, if they are getting in-kind payments, we can tell them, if you go ahead and you put it aside and you keep it as a business use because you're really not going to use it, it might just sit in their closet instead of them wearing it. Let's turn it around and let's get it back out there and get some of that income back off your books.
Yeah, if there was a safe harbor that said if you sold it within 30 days, then ultimately the cash you received is the value that, then it would be a tax planning tool for people to sell the stuff they don't want. Right.
Exactly, exactly. And you look like a superhero instead of just this stuffy accountant that doesn't understand them.
Well, I was thinking about too, like, imagine someone that is a travel influencer and they get a free hotel room. Ultimately, they got that you've got just so many issues with that. Um,
That
you
one's
know,
hard. That one is harder. Yeah, you're taking that. Then that's where you start to become really intentional with your trip, right?
exactly. Do you want to even, oh gosh, there's a lot there, and
Yeah, yeah, because now you're getting income. So then that's the tax planning mindset is, okay, I'm getting a $12,000 hotel stay because I'm going to go do this for the company. This is work. So what else now can we generate in form of expenses to, ensure that it's not just sitting there as a gross income without anything attached to it.
well, one of our three laws of tax planning is this concept of tax flow and cash flow. And people, they understand cash flow, but people don't understand tax flow. Tax flow is the tax burden or benefit of all your decisions. And in your case, you have influencers with a ton of potential phantom income and no
Yes.
cash. They might not even have the cash. It's similar to depreciation recapture of people say, well, saying they don't have cash, but well, because they went on and they bought an $80,000 SUV, wrote it all off 2 years ago. They go trade it in. Of course, they owed 60 grand on it still. So they walk away from the
Mhm.
dealership with no cash and say, yeah, you realize you got depreciation recapture. Oh
Oh,
Lord.
I mean,
So
come on. They'll say, I don't have any money. I don't have any money in my bank account. Why do I owe taxes? Because the IRS doesn't care what's in your bank account.
mhm.
They
Or
don't
I just
care.
or I, this is gonna segue into some entity selection, but well, I kept the money in my business. Well, okay, are you a C corp or something?
Yeah.
So when do influencers when does it start making sense to form an entity or to potentially, incorporate, I would
Oh,
say.
that is such a fabulous question, because here's the thing that I learned through trial and error. I love that. really, when I was first helping them, because I went straight into high net worth influencers. So I'm not talking about little people with side hustles, even $100,000 a year. That's very, very small in terms of the influencers I work with. But you have to keep in mind that generally most of them are very young. And so you see them, and this even goes beyond entity selection. I talked about this at Taxposium. When it comes to these high level strategies, I'm talking high level, like, well, let's get you an Airbnb and maybe do the short term rental loophole, or let's start getting you set up for reps, or let's talk about all of these high level tax planning strategies, because those don't change. Those tax strategies are the same high level strategies you'll use for your influencer making $1 million, but you have to be aware that they might not be emotionally and mentally capable of implementing it or working with you to implement it. So, in terms of easy entity selection, the S corp, you're gonna want to help them with the S corp. They If they're making a lot of money, they're making over $50,000 net. You're kind of like, okay, now the benefit would be in it would be in your best benefit to be the S corp. But we know as tax professionals, the reason why we have that threshold is because once they become an S corp, they're going to have to be on payroll, and they're going to have actually good books with good balance sheets and everything. They're going to need to do an accountable plan, and they're going to need to fill in their accountable plan every month, and they're going to need to stay, within, if they want to play the big kid game of tax, they have to follow the big kid rules. And so we can look at it, but then, they might fall off the face of the planet. They might decide they don't want to influence anymore. They might, and then all of a sudden now you have an S corp set up, you have payroll accounts open, you have all kinds of balls up in the air, and they're like, no, I don't want to do it. So I think it's not so much about it. Of course, we keep our same net income threshold that we have for every client, but we also have to do an additional analysis with these types of clients to figure out what their long-term goals are, and then to really sit down and educate them about the part that they are going to need to play. Because if you just throw them into an S corp, trust me, I've done it. I'm not saying this is like, I don't and you do. I've done this. I've thrown them into S corps, and they're making a lot of money. So I'm like, we should probably zero out their payroll, like get ahead of the estimated taxes. Let's zero it out. It's monthly. And then they look and they go, where's my money? And they don't understand anything. And so it's really, really important that you sit them down and you actually have a consultation with them, and you say, hey, if you want to save this money, this is what's going to happen. I get influencer clients. I just got one just 2 days ago that came to me super frustrated with her old CPA, all the same, complaints. And she has an S corp, and I actually checked the transcripts. We did the transcript monitoring. This CPA set it up right, which isn't always the case. That, you can check their transcripts, and there's all kinds of problems with the IRS that they didn't know they had, and you check their transcripts and it's a mess. But she was set up correctly, but there was no payroll ran for all of 24. She's done nothing for 25. She has no idea. There's no accountable plan. She's still got one big bank account that we're trying to go through right now. And currently, I'm just trying to get a handle on her. I've learned my lesson of taking on every influencer, because they all kind of tell you the same sob story of no one understands me. And so while that's often true that their CPA might not understand them, they also tend to fail to mention that they're also not willing to do the work required, right? So that side of the perspective we often miss. It's another thing that's very important when we're evaluating entity structure, as I was talking about before. So we kind of take all of those things together into account when we're deciding where to go from here in terms of helping them with the best structure for them.
Absolutely. Sometimes you have a client that the S corp might make sense, but you just know in your heart that they're just not going to do what they need to do. They're not going to create keep their, sometimes you got commingling of bank accounts, distributions, et cetera, but they're not going to contact everyone if they formed an LLC and have their LLC be paid. And you just don't have the confidence they're going to walk like a duck and act like a duck and quack like a duck. So we have to
Exactly.
factor that in. It takes our cooperation too. Like we wanted to get a reasonable compensation study on the books for and someone that's going to be an S corp. They also they need to fill out a survey. And some clients are so hands off that, and guess what? We all are, right? Some of us are willing to pay a premium for convenience, and sometimes that's a tax. Like,
Yeah, or it's an advisory fee because I have those clients. I mean, I never have them fill out the survey alone. We'll Zoom and we'll walk through the survey together. It's that special advisory fee, that special hand holding. So it's a good way to upsell your services. But at the same time, there's certain people that even if you hold their hand the whole way through, they're still just not going to cooperate. And I always say, I'm not in the business of fighting with you. So if you want to fight and I feel like I'm in a relationship where we're fighting, it doesn't matter to me how many followers you have or how much you pay me a month. I don't want to do that.
right, right. I agree. We don't want adversarial client relationships. So I mean, you want respect. Yeah, you might see things differently once in a while, but you're ultimately on the same team. In which sometimes let's talk about sometimes when as a tax professionals we have I don't want to say disagreements, but maybe some interpretational issues with our clients, and sometimes that's healthy. But in the influencer space, one of the things that's very confusing to practitioners that don't work in that space a lot are mixed use expenses. Can you give us some examples of, because obviously, let's say you're a tax professional, you prepare 500 returns. You have that one influencer that said, "I just baked a cake in my kitchen. Now my kitchen's my full 100% home office deduction." What's your best advice there?
Yeah, I actually just got sent by a client a reel of a girl saying that she said, her accountant told her she can write off her whole house because she films in her house and her pool. So, make sure that you guys get a pool. And it's just funny. And that's kind of a perfect transition when we're talking about fighting with the clients and being on the same team. I am on the same team. I do not want to see them overpaying in taxes. I love to tax plan. I love to strategize, but we have to work within the confines of the regulations and the code that the IRS gives us and the tax court cases, right? Because we've kind of,
Mhm.
it gets blanket and we search and we research to get it more detailed. So what I have done is I've kind of looked at a lot of different tax court cases and noticed that there's four general frameworks that the courts are using when it comes to these mixed use expenses because you've got section 162A that talks about everything's ordinary and necessary. And so you see the big tax influencers, I won't name names, but we know who they are, walking around saying, well, it's ordinary and necessary for my business, so I'm writing it off and you should too. But no one talks about that little black sheep code section 262, that talks about how inherently personal expenses are not deductible. And I don't know if I have the case in front of me. I don't, but I loved the one, maybe we can put it in the show notes, where they were arguing about how I need the medical treatment so I can go out and run my business. I need clothes to wear so that I can work. I need food. I need shelter. And they say these are all great arguments, but they're also the exact illustration of what inherently personal expenses are that are expressly denied by Code Section 262. So no one wants to talk about 262. They always want to talk about 162A. And it starts to get really, really muddy when your life is your business because you're an influencer. So back to the frameworks. So we've got the inherently personal, which I just talked about. We have the excess cost framework where you can deduct only the extra cost incurred for business. Of course, there's that allocation. Now, this is one we as practitioners deal with all the time. We've got the cell phone that's mixed use. We've got the home office. We have stuff like that. And then the primary purpose, which if it is dominantly for business, it is allowed. Of course, that one is the one that gets abused. And so we have to lean on these court cases and these frameworks when we're making the decisions. We can't, we have to go back to that foundational stuff that we know.
Exactly. And sometimes clients are going to take it to an extreme. Everyone wants to be the person that said, "I got to write off my Lamborghini and I've got to do this." Like, it's just because
Yeah.
that's what they're doing. Like, that's what they're in the business of doing, is getting clicks, getting attention. And then sometimes there's certain cases that, uh, I hate to use the term stick out like a sore thumb when we talk about the Chesty Love case and people just applying it to every cosmetic uh, surgery, every procedure, saying, well, that one situation, it doesn't really apply to everybody, does it? It's
No, and let's actually talk about that because with the influencer space specifically, cosmetic surgery is a big thing, a big thing. We've got BBLs, we have augmentation, Botox. I mean, I see it on the clients' charges all the time. And I've had to have these conversations. They don't believe me, they don't care. They just want to argue till the cows come home. But the Chesty Love case is a rare exception where this was actually allowed as a business expense. So if you back it up to medical deductions in general, just a general qualifying medical deduction on Schedule A, you see that there are already AGI limitations. There's a huge long list of qualified medical expenses in the first place. And that's generally where your medical expenses would go if they were even qualified and if you could pass all the other tests. So moving it from there to now being an ordinary and necessary business expense, it's even more rare. I read a case about a professional singer that went to a throat doctor, a specialized throat doctor to keep his voice in good shape, and deducted it as an ordinary and necessary business expense under 162A. The IRS denied it. They took it to court. And the tax court also said, well, there's too much inherently personal benefit from this. And it is a qualified medical expense. So you may deduct it on Schedule A, but you may not deduct it as an ordinary and necessary business expense. So, and that was literally his throat for singing. I mean, if he would have come to me, I might have been like, well, I can see it, and even something like that was like hard no. So,
I mean, I could see that too. And we're not, you kind of, we talked about this before, is we're not in the business of telling our clients no. We're trying to find them a yes. We're trying to get them legally and ethically reduce the tax they pay in their lifetime. But we also have to be cognizant of things. I mean, think about like a gym membership comes up a lot. Now, let's say you can make an argument, well, I got to stay in shape if I'm an influencer. It's still inherently personal. However, what if you're a fitness instructor, and you are modeling and you have a whole library of online um, uh, exercises, routines, workouts, and you pay for a film crew to get in there. Then you could it's a different situation, right? The facts and circumstances are different.
I think so, yeah, and you have to take into account the influencer's unique profession because that goes back to understanding what they do and who they serve in their business. For sure, we have the Hamper case. That was the newscaster. I want to say it was 2011, and she was on TV. She deducted her wardrobe because she had to wear, certain colors and patterns, her hair, her nails. She actually did deduct her gym, which is why I thought of this when you were talking about that. She needs to stay in shape. She needs to look good. I thought this was a very applicable court case due to the fact that she's a well-known figure. She has even more limitations around being on camera than a regular influencer does. And every single thing got denied, right? They said it was all inherently personal. Everybody needs to wear a certain type of clothing to work. You can't get to your gym and all of that. It's too personal. And so while we're not in the business of telling our clients no or fighting with them, I also don't want to put them in a position where they are in a lot of trouble if they ever get audited, because 95% of them, all of these deductions would get denied, just like they did with Hamper. But, you look at the stuntman case, he was in the gym and they allowed it because that's his life. So there are exceptions. And I think you're right about having a full person who's working in the fitness industry. But, a lot of them at this point, they get their own gym when they're serious and they're training
Right.
people and they're filming. They have a gym in their home. And as you know, the home office and all of that's a completely separate animal that we can work with. So if they ever want to write off the gym, we kind of start having talks about, okay, but how can you bring the gym to you? I kind of tell them it's like stepping over dollars to pick up pennies. You can write off a $20 gym membership. You want to fight me on this membership? Let's talk about maybe making a gym in your home that's exclusively used for business and you're training your clients there and you're creating your courses there, we can get creative and we can think about better and bigger ways to strategize that fit for the client and will save them a lot more.
You nailed it. I agree. That's um a whole different animal, and same with maybe someone that has extra space in their home and wants to create it more of a commercial kitchen, instead of having stuff spread all over their regular kitchen. I mean, there's a lot of interesting things. Can you talk to us about, as tax professionals, when do we have to think about influencers establishing nexus somewhere? For instance, let's say you live in Nevada, like many of these, non-tax state, but you happen to go to California. Well, California is a bad example
Oh.
because there's sharks over there. Oh my gosh,
Yeah.
I've got some bad stories.
If your client looks at California, they're going to pay taxes. There you go.
Yeah, exactly. If they step
If they
foot,
glance
we
in the
had a
direction.
client. Oh my gosh, they went to a trade show there as a vendor, and they just set up a booth, and California got them, and went after them. I said, "Let me ask you a question. Did you sell anything in California? Did you have inventory?" And they're like, "No, I'm not even going to say what industry it was. It was like a piece of machinery. No, we were just there." Okay, and we were able, but they tried to ding them for a non-resident LLC filing at $800 fee. It was ridiculous. So stay away from John and I make fun of California all the time on our other podcast. But
It's definitely the butt of some of our jokes. We're just like, just don't go there. It's okay.
yeah,
You can view
John
it from
perked up
afar.
because he heard about that the Chesty Love case. He's back
It
in
got my
action
attention.
now.
Yeah.
My
But
ears
yeah,
perked
so
up.
what should we be aware of when a client is maybe going to other states? Typically, we've had clients that are actors, but a lot of them are in the union, the guild, and
Mhm.
they're on a W-2. They're actually on W-2 from whatever motion picture they're in, and they will have that non-resident withholding. But for someone that's a freelancer, or maybe they started an S corp, what are your thoughts on that?
Yeah, that's definitely something to be aware of. I was talking to another group about this, and someone said, "Oh, like an NFL player." And I said exactly what you're talking about. I said, "We love an NFL player because we're going to get a W-2, and we don't care if it's 50 pages long. We've got the withholding, they have the payroll account set up, everything's nice and pretty and in a bow." But when you have clients that are traveling, it's different. And then you also have to think about, are they like if they're selling products and traveling. You were talking about someone who went to a trade show. So I have a client here in Utah, and she does a lot of trade shows and fairs, and every time she travels out of state, not only do we have to worry about just barely, she went to Nevada, so she might not have an income tax liability, but she's going to have a sales tax liability because she's going to have physical presence there. And so if you have a client who's an influencer who's actually traveling and selling products, then you have to think about sales tax on top of it. But let's just use my client, for example. He's a professional athlete, but he's a freelancer. So he's a 1099, and he travels all over the nation he is so cool. He's the best. He does really cool, like freestyle motocross shows. And so they'll pay him, per show in different cities. So when I got him, I quickly learned I'm going to have to get his tour schedule. I'm going to have to get his compensation schedule. I'm going to have to figure out, what the responsibilities, the reporting requirements for each state are, because some are different and some have, limitations. Okay, well, you've only been here for so many days, or if you've earned under a certain amount of income. So these are things that we could never figure out, even if we spent the whole podcast. I've taught classes on sales or income tax nexus and state sales tax nexus before, e-commerce, and I will have an hour class and I cannot even dent it, right? Like, it's so overwhelming because, as we know, as practitioners, every state is different. So this is where I really try to just get the awareness out there that it's something that you could find yourself in a bad position of scope creep if you are not asking these questions in the beginning. So my client, I didn't ask him these things. I didn't know he also competes globally right now. And he just called me. I needed something from him. He called me. I think he was in New Zealand. And he's like, I'll be back for a day and then I'm leaving again. And so B, C, X, whatever the letter is, also keep in mind, they can be super hard to get a hold of. So it can be frustrating to get your work done. Like I have one day when he comes back where he can sign stuff for me and he has access to a computer and then he's gone again. But besides that fact, just understanding that it's going to require more work and getting your fee schedule prepared based on what they have beforehand. And then if they tell you no because you're too expensive, they can find someone else. They can find someone who maybe has more resources to do these multi-state and international filings, that isn't you. But I've had calls with models, and, they're like, oh, well, I shoot here and I go here and I'm here and I'm here and I live 6 months here and I'm 3 months here. And I'm like, I don't think we're a good fit. So just really having that, grip on what you're willing to do as a practitioner and knowing your pricing about it so that you don't get these unpleasant surprises when you're already in an advisory agreement, especially.
Yeah, I mean, and this could be a whole, and maybe maybe we will coerce you. We'll have to increase that big paycheck to, but we won't film this in California to get you back because you've got
Mm,
other things like your athlete could be competing internationally. He
yeah.
could, or, so there's a lot of different things. And I want to touch on the practice management part of that, the scope creep. Do you know, obviously we don't want your rates and everything, but do you set up a client? Do you charge a client setup fee, or in your engagement, do you have kind of some loose language that says, hey, if we identify a state or locality that we feel you have to pay tax on, we're going to charge you a certain amount per state to explore it? Like, how do you manage that scope creep? We have our own way of doing it, but really want to hear about yours.
Yeah. So I definitely have an onboarding fee, right? And it used to not be as much. Now I've increased it in general because the client will constantly, it doesn't matter. This could be an influencer, this could be anybody. Oh, it's easy. There isn't that much going on. I'm fine. And then you run their transcripts and you're like, we have a mess. And this is going to be a long time coming. So I have the onboarding fee, but I have learned really that beyond what's in the engagement letter, of course, there's language in there to say we're going to increase. And for every state, we have an additional filing fee, right? Like I have that in the engagement letter, but I have really, really learned that it comes to communication from at the beginning. Like cut what I was going to say, cut the head off the serpent. I don't even know where that came from. That was so weird in my mind. But you basically face the problem before it becomes a problem, especially with influencers, because they just have no idea the ramifications. But again, I don't think most people do. I think you could be a 45-year-old traveling, salesman and you wouldn't know about, income tax and state nexus. So you want to ask the questions because I think you get they paint such a pretty picture and they don't really talk about the details. And so I want everybody listening to this, and when I'm teaching other tax pros, all I want them to do is to know so they can ask the right questions and then right there during the call say, that's a very complicated situation. This is going to be something we're going to have to talk about with pricing.
Yeah, Nexus is big, and it's a tough one for us practitioners because there's there's no value seen by the client. Like, hey, you might get caught and do this, so you're going to have to pay this and or they could ultimately it's communication is the key. Like if you're let's say you're going to spend one day in Connecticut, probably they're pretty strict, and you're a freelancer and you don't sell product, you're probably not going to allocate $150 of it. I know every state's different. We've had the Wayfair case and then different people implementing it, but you just got to also be reasonable, right?
For
Um,
sure. For
and
sure. 100%.
yeah.
Yeah.
So, but I bet imagine, and we actually had a client that was in the professional services field. They grew exponentially, ended up, they were a S Corp, and actually taking salary, which is nice. Two owners, but they grew and they had team members in about 20 states. So they ended up having to file in like 25 states. And they ended up revoking the S Corp just so they didn't have to file personally in all these states. And said, we're going to pay a little more in payroll tax here, but the compliance cost for them to do non-resident withholdings in 25 states and the tax, it was just nuts. Because ultimately, from the C Corp perspective, they didn't have a lot of profit in these states. There wasn't much tax, which is, I'm just saying, I could see that in your case, if someone was who knows, right? They might have an operating company that's a C corp. I see some strategies as far as shifting income and stuff like that.
Yeah, and I actually have a client who just came to me, and he went to a lawyer and they set him up with an S corp and did the S election and everything. And I've been helping him, and he's in Ohio. And so he has Rita, he has all of the different yeah, John. Boo, thumbs down.
My thumb's down. But
Yeah,
you're a
thumbs
Michigander is
down.
saying that.
He's in Ohio. He came to me. Oh, you know what? As I was looking at everything that he has, filing as an S corp versus filing as a Schedule C, I have really, really been wondering if the additional compliance costs here are worth it to make the change. And the fact he takes so much in draws, he has basis issues. There are all of these things with the conversion that I'm looking at now going, I don't know if this was the best idea, even though it seems like it on paper. You just need to be able to communicate that so that you don't go to so if they go to another practitioner, they say, I can't believe they weren't filing you as an S corp. What are they doing? Thinking that the S corp is this magic fix all when there could be a lot of detailed reasons underneath, like what you were talking about, where it's not worth it.
It's similar to booking flights. If you just focus on the cheapest flight possible from Boise, Idaho to Miami, Florida, you can accomplish that, but you might have 3 connections, which it takes up time. You might be on an airline that charges you to select your seat. What if you're a mature age person, you have mobility issues, and you simply can't get from point A to point B to the airport in the nick of time. And then there's all these landmines, like 3 connecting flights, one's late and you're in trouble. And now you're causing yourself more money because you got to maybe spend the night somewhere. And I don't know. And so you nailed it. Like there's a lot of factors involved. It's not always.
That's a good one.
Yes.
If you don't do something from it, I'm going to steal it. So you better make that content quick.
I know. Well, we'll send you the pizza buffet one, but I'll do a,
That's just like the video I did, how Chat GPT is like contour. We get these ideas. I'm like doing my face. I'm like, you got to blend your words, blend your contour. You got to pick the little bit more of an expensive flight so that you're not stuck in a foreign city for 48 extra hours.
exactly. It's the old price versus cost. So, well, I've learned a lot here I mean, again, I truly enjoyed your presentation at Taxposium, and I really enjoyed your content. And you're officially a friend of the Mr. R Show, so that's always an honor, I'm sure.
Thank you. I'm honored too. Thank you.
Absolutely. Well, yeah, I mean, this was a good topic too, because we dove into something that I'm sure there's a lot of interest around too, but then I'm going to make the assumption that a lot of people don't realize the grass is not always greener on the other side. Sometimes they get over there and it
Yeah.
might be AstroTurf, right? Like
Oh,
it's a total
yeah.
facade, and you brought up some
Mhm.
good points, right? Just the little but huge complexities of working with specific types of clients. And I don't know if complexity is really the best word, just things that they need to be aware of, right? You brought up some really good ones. Kind of like Chris. Like Chris knows how difficult it is to work with me, but he just deals with it, and vice
Yeah,
versa. Right?
nuances of John.
There you go. I should write a whole book of those.
Yeah.
Although my book of bad dad jokes will be way longer than that. So we'll leave. That's a whole nother.
Oh, they're terrible. I
Oh,
gotta
they're
hand
bad.
it to you. They're bad. Well, think about if you do advise clients, sometimes it's easier to get out of a marriage than an S corp. So before you jump into that, you got to think about it. You got to think
Yeah,
about
I
that.
love that.
On that note, I think we should part ways, at least for now.
Oh,
So let's definitely we'll be diving into this more in specifics. As things change, obviously, as new tax law kind of rolls out, obviously some things will tweak throughout that. So yeah, we'll have to have you back. We'll revisit some of these, and for anybody that's listening to this too, definitely check out the show notes, connect with us through that, reach out with any questions. And the little bit of advice that I could probably give, not being a tax pro, right, is if you have any questions, maybe talk to somebody about these things before you take on one of those clients, right? If you have certain stuff. So we'll put contacts in there. They're there for you, not us. So take advantage of it.
we really appreciate you, and we'll put all this information in the show notes. If you're a tax professional listening, if you're listening to this and you're not a tax professional, first of all, thank you, because my wife and parents don't even listen to this unless you're a tax professional. But second of all, if you are a tax professional, definitely don't be afraid to work with influencers, but make sure you connect and make sure that you have the right people around you to help you out.
Definitely.
And that note, we'll definitely part ways. But we'll see everybody soon. Back here again on the Mr. R Show.
You've been listening to the Mr. R Show, presented by the MRR Institute. For more content like this, be sure to check us out on YouTube for weekly expert tips. And don't forget to subscribe to this podcast to stay updated on the latest strategies for scaling and modernizing your tax practice. Looking for more? Contact us at mrrinstitute.com for practice resources, coaching opportunities, and a peer-to-peer mastermind group. Thanks for joining us, and we'll see you next time.
The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer.